Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these weekly Monday morning at 9 a.m. Eastern live streams, stock market news, giving you all the strategies, the trends that you need to know to really get you ready for this week. Gonna get started here because we obviously got a lot to talk about. It had seemed last week that Russia and the Ukraine conflict had kind of eased out of the market when President Putin did say that he was open to talks with President Zelensky over there in Ukraine. The Ukrainians had been able to keep the Russians out of Kiev, had been able to defend the capital city there. And it looked like it was going to be a fairly short conflict that didn't metastasize out into the broader global economy and involve more countries. That obviously changed over the weekend. We're going to talk about how that's changed, how long this could go on, and how bad it could get for stocks. We've actually seen we saw some good news Friday. A lot of the rebound Friday was on a clarification of sanctions from the U.S., from European countries, that those sanctions wouldn't touch things like the oil industry in Russia, wouldn't affect the agricultural industry in Russia, but they would start doing some financial sanctions and things like that. Very important because obviously Russia is a large part of the global oil market as well as the agricultural market. So the market was kind of benefiting from the idea that these two very large markets from Russia wouldn't be affected, and yet the Russia and Ukraine together are only a very small fraction of the global GDP. So if it doesn't touch those two markets, the oil and the agricultural market, then the market was thinking that it wouldn't affect global GDP very much. And that's what you got that rebound from on Friday. Obviously, that's changed, and we're going to talk about that today. I'll also talk about kind of what the sectors are doing in this during this conflict, what different stocks I'm watching, and what to watch for this week, because there's actually two other points besides the Russia situation that could cause some weakness in stocks this week. So very important that you know and check those out. First, though, before we get started, we've got a lot to talk about, but I do want to thank today's sponsors, Morning Brew. I've been reading the daily newsletter from Morning Brew for more than a year. It's got some great inside analysis and really goes deeper into a lot of the topics, the economics, the investing and market topics. So great newsletter there, and I love that they now have a channel, a YouTube channel. Of course, I always kind of nerd out on the market and economic stuff, but they also cover tech and games and a lot of other stuff. One of the funniest ones, this Kanye or Elon Musk. They actually did kind of a man on the street kind of thing. Kanye versus Elon. Can you tell the difference? And it was just hilarious. So check that out. A lot of other videos here. I love the Founders Corner, the Founders Journal videos with one of the co-founders, just kind of talking it through concepts in more depth and with news articles, but it's still got kind of that humor that you find in the newsletter. So doing some great things with that. I'm going to put the link to Morning Brew YouTube channel in the chat above, as well as in the description below. Check that out. Subscribe. I highly recommend, again, that Founders Journal videos as well as that one on Kanye and Elon. Definitely have to check that out. See if you can actually tell the difference between the two, because some of those questions I couldn't. But we're going to get started here because, like I said, we've got a lot to cover today. Investors did breathe kind of a collective sigh of relief on Friday on that international coordination and sanctions that could bring Russia to the bargaining table sooner rather than later. But obviously, we saw that kind of fall apart over the weekend. It does look like the stock market is going to close quite a bit lower. About futures down about 1.5% so far today, well off their lows though. At one point last night, futures were down as much as 3% on the NASDAQ. So it looks a little bit better. Now, I don't have any crystal ball on this, right? But it strikes me that this is far from over, obviously. The fact that Ukraine has been able to keep Russian forces out of Kiev, out of that capital city, and really halt the country's advance tells me that Putin isn't quite in the bargaining position of strength that he likes to go into when he starts negotiations for these kinds of things. You did see him call up his nuclear deterrence force over the weekend, really kind of emphasizing that he and Russia are willing to go to whatever it takes to do this. And obviously they're not. Russia is not is not willing to go to nuclear means to resolve this, definitely. But they have to, to be able to bargain and negotiate what they want out of this, they have to look like they're willing to go as long as it takes and as far as it takes. The international community has cut Russia off from a lot of the financial systems. Talking about cutting them out of the SWIFT system. The ruble has plunged to an all-time low, dropped about 35% from where it was before the situation, and the central bank actually had to double its interest rates. Interest rates in Russia were already right around 9.5%. They doubled it over the weekend to over 20%. So this is causing some real economic pain on Russia. But as we've talked about the last couple of weeks, the problem here, the reasoning here, is that Russia and Putin they view this as a threat to their sovereignty, a threat to Russia being able to exist right on the world stage, and that's really talking about its access to ports, its access to to trade and that kind of thing from these countries in Eastern Europe that are gradually pulling closer to the Western organizations like NATO, like the EU. Okay, a big part of this is Ukraine, which has those warm water ports on the Black Sea. Okay, for Russia, you got to understand any way to use their navy, they have to have those warm water ports. Okay, and they just can't do it from Siberia, right? So they need those access to warm water ports. They need access through the through the Baltic Sea, through into the Atlantic. So what you'll see a lot of times from Russia is kind of bullying these other countries, these countries that have those access. So Ukraine has the access to the Black Sea, which is a lot of the reason why Russia annexed the Crimea a couple of years ago and is now trying to take Ukraine totally, because the Ukraine has been talking to NATO, has been talking to the European Union about inclusion in those organizations. And Russia is afraid that if Ukraine is pulled into those Western organizations, that's going to cut off its access to the Black Sea, as well as trade and different routes. We also saw that late last week when Putin threatened Finland and Sweden as well. Because both of those countries have been fairly apolitical as far as whether they favor the West or Russia in the past. But they have been pulling closer to the EU and closer to NATO, right? So again, Putin came out, threatened these other countries that it would not tolerate them being closer to the West and potentially cutting off Russia's access to to the Baltic Sea up there and its trade routes and things like that. So that's where Russia is coming from in this, and again, that's going to be the negotiating chip that they want. That's going to be what they want out of this. All right, Russia does not want Ukraine. It's a very strong national people. They're not going to give up the country without a fight, and even if Russia is able to take Ukraine, take Kiev, the capital, then it's going to be a quagmire. It's going to be worse than Afghanistan was for Russia back in the 80s, and it's definitely something that Russia does not want. But they do feel threatened by more countries going over into NATO. So they're gonna do what it takes to be able to back these countries into a corner and say, hey, you know what, we'll pull out. We don't want Ukraine anyway, but you can't be part of NATO. You can't be part of the EU, and we must have access to these warm water ports. So be looking for that. That's ultimately what Russia wants, and so that's what they're going to go into bargaining for. And again, with I don't see Putin quite in that bargaining position that he likes to be in just yet. So he's going to drag this out. He's going to want to try to actually almost take Kiev if he can, because obviously that's going to give him a stronger bargaining power when they go into those negotiations. Let's look at the look at the markets though. Last week, this week it does look like the S&P looks like all the indexes are going to open in the red. Let's refresh this so we can see it's about 20 minutes until the market opens. We've got about 1.5% down on the S&P futures. about 1.33% down on NASDAQ futures. Obviously, gold or crude oil has spiked, just more on that fear that Russian oil supply might be cut off from the rest of the world. And so you're seeing that crude oil spike. We just did see gold come back up. An interesting thing about gold here is that just over this last week, as the Ukraine situation unfolded, gold actually did break out of that long time range. It's been in a range for about the past 2 years, from $1,750 to $1,850 an ounce. Even sky high, multi-decade high inflation couldn't break it out higher out of this range. It took almost a world war, a threat of a world war, to break it out beyond $1,850 an ounce. It broke $1,900 last week, but on Friday, as we started to see the hopes of that tension ease, it came back down under 1900. Now, obviously, with the tensions flaring up back again, and the market effect flaring back up again, we are back over $1,900 an ounce. But understand this: I think gold it's obviously overvalued right here, unless we do get some kind of a larger conflict and escalation of this thing. So any kind of resolution, any kind of a hope for resolution, and gold is going to come back down quite a bit. So I think you got to be worried. You got to be careful about gold here, because it could come down pretty dramatically. I still do like the gold miners, because they are very much cash flow positive, with gold prices even at $1,750, even at $1,800 an ounce. A lot of those gold miners are just cash flow machines. So I would be looking at those instead of a direct purchase of gold. Last week, the Dow index of stocks had its worst and best day of the week, or of the year, right? Plunging on that initial invasion, but then rallying on Friday. So the index is still closed slightly lower than the S&P 500 and the NASDAQ. Both actually registered gains last week. So on that Friday rally, and that was really supportive of this market. We'll get into the sectors here. Last week, sectors, the S&P 500 did close about 0.8% up higher. Only 3 sectors closed lower last week, and that was consumer discretionary, consumer staples, and financials. Again, we're using the sector tracker here on sectorspider.com. Great resource to kind of follow that big picture idea in the individual sectors. If you go into consumer discretionary sector here, this was interesting why it underperformed so much last week. So the rest of the market up about 0.8%, consumer discretionary sector down 2% last week. And if you click through here, you kind of see why. We'll change this to the worst stocks in the consumer discretionary sector last week. Of course, you saw a lot of the travel and leisure stocks, the Booking Holdings, the gambling stocks, Wynn, Las Vegas Resorts, Carnival, all the cruise lines got hit last week, but a lot of that was the 5.5% drop in shares of Tesla. Tesla is now 16.5% weight in this consumer discretionary sector. So, wherever Tesla goes, that's going to kind of guide the direction of this entire sector. Now, the thing is, though, even if you remove Tesla from the consumer discretionary sector, you remove this 5.5% drop from Tesla, the consumer discretionary sector, the stocks in that sector, still would have dropped more than 1%, which would have been still a 2% underperformance on the market. So that was really interesting that they sold off so badly, even though consumers still tend to be in relatively good shape. Lots of credit, Credit is actually expanding in the consumer space, and consumer spending is strong. So I would actually look for, I would start looking for sell-offs and opportunities here in the consumer discretionary stocks, because those are getting into value territory and selling off, not necessarily for great reasons here. I'm going to cover some what to watch for this week, as well as some stocks I'm watching. Obviously, the market is going to be the direction is going to be dictated on how that Ukraine conflict unfolds, whether we get Russia to the negotiating table sooner rather than later. And again, obviously, I think this will get resolved before it escalates into a full-scale world war or a multi-country war, because Russia can't afford that, does not want that, can't afford it. Like I said, we've already seen interest rates double in Russia. It is going to cause some real economic weakness on the country and on its citizens. and Russia it doesn't want Ukraine. It just wants the guarantee that it will have access to these trade routes, to this trade, and the warm water ports. The other thing, there's two other things you want to watch for this week. The other one is Chair Powell, chairman of the Fed, testifying before Congress on Wednesday. Investors are obviously going to look for clues on how the Fed is going to react to that Ukraine conflict. I think, obviously, I think Powell, he's going to be asked about this, whether that changes their view on higher interest rates. And on that possible rate hiking cycle. Now, I think he's probably more likely than not to be hawkish, okay, which would mean higher rates, which mean less accommodative, okay. When you hear about the Federal Reserve and policy statements, you're going to hear hawkish or dovish, right? Hawkish tends to be more restrictive. They want to raise rates, they want to slow down, inflation, things like that. Dovish, they're going to cut rates. They're going to be more accommodative, more stimulus into the system and into the economy. But I think he's going to strike a hawkish tone here because he wants to maintain that perspective that the Federal Reserve is serious about fighting inflation. Especially with the PCE index out last Friday. Again, another inflation index that was up a multi-decade high, the highest it's been since 1984. I think it struck at 6.1% on a year-over-year basis. So he is going to definitely want to continue to maintain that drumbeat of we're going to raise rates, we're going to fight inflation, we're going to bring it down to our target, right? So that could be another potential to spark a sell-off on the markets if he's more hawkish than the market is expecting. Most of the market expects him to say that rate hikes are still on the table. They're still probably going to be coming in this month in March, right? But I think he's going to be a little bit more hawkish than expected. The monthly jobs report is also scheduled out on Friday, and this is usually the big economic report of the month. It shows you how many jobs were created in the United States over the last month. The expectations are only for 400,000 jobs to be created in February, and that's versus 467,000 in January. Now, I think this is our first potential, first big potential in quite a while for the jobs numbers to actually surprise on the upside. Okay, we do know that job postings picked up in February. It was also the first month in quite a few that the Omicron variant of COVID really wasn't a factor. So I think a lot of people were coming back to work, taking those job postings that did increase. So I think you have a very good chance. And this 400,000 jobs expected, for the month strikes me as extremely low, compared to what we've seen in prior months. So I think jobs numbers is going to be well above that. The thing is, unfortunately, it's less clear about how the market is going to take that. Is it going to be a signal that, hey, the economy is good, corporate earnings should be good, stocks are good, or is it going to be a good news is bad news kind of thing where people look at a strong economy, strong jobs picture, and that means the Fed is going to raise interest rates even more, okay? Because the Fed has to balance those two mandates. The Fed only has two mandates to do. One, it has to protect jobs, it has to support the jobs picture and employment, but it also has to bring down inflation. It has to keep the economy from getting so hot and growing that inflation so high that it just destroys the value of the dollar, right? So it raises interest rates to bring inflation down. It lowers interest rates to boost the economy and boost the jobs picture. Well, what happens if jobs picture is just fine, jobs picture is better than expected, then it's got more leeway to raise interest rates and fight inflation, right? And I think that's what's going to happen this Friday. We're going to get a very good jobs number, much higher than expected, and the market's going to take it as a signal that the Fed can raise rates even more to fight inflation. So I think Friday could be another opportunity for a weaker market if the Fed or if the jobs number comes in hotter than expected, and that's how the market takes it. I want to look at some stocks I'm watching this week. Just a last few earnings coming through this week. Earnings are almost over for the market, but we do have some important companies reporting. Zoom Video Communications, ticker ZM, is going to report earnings after the close today. After the close Monday, is expected to report $1.11 per share on $1.25 billion in revenue. So obviously this is kind of the poster child for that, for those pandemic growth stocks. It has come down quite a bit. If you look at the 1-year picture here, it's come down from that high of $440 a share down to 125. So it's come down, almost, we'll call it almost 75% down on this stock, right? And most of these pandemic growth stocks have done this. Shares are still relatively expensive though at 9.8 times price to sales. So a lot of what we've been looking at over the past month, over the past couple of months, is these growth stocks, these stocks that are undeniably changing the future, right? Changing the way we live, like Zoom, like Shopify, like Teladoc. These once very popular growth stocks that have come down so much, were once trading at 30 and 40 and 50 times on a price to earnings basis, now trading under 10 times on that price to sales ratio, where I actually start to like them, start to look at them. I don't generally look at growth stocks until they come down under that valuation of 10 times price to sales. Zoom is just barely there, 9.8 times on a price to sales basis. But I do see some positive, a way for the company to report positive earnings. It's probably going to beat those earnings per share and the sales. But Zoom recently started limiting its free accounts to a 40-minute call, right? I used the free account on Zoom, never felt the need to pay for it until about the last month, when they actually did start limiting those free calls to 40 minutes, okay? In the past, you could set up a free call on Zoom. If it went over 40 minutes, it was no big deal. They wouldn't cut you off. Now they're actually starting to cut people off and force you into those paid subscription trials. So if management can kind of give a positive outlook to that earnings report later today after the close, then you do have a chance of seeing these shares rally. What you've seen over the past few weeks, over the past month with earnings, is a lot of these stocks, they come out and they guide lower on their outlook. They tell they honestly they just come out honest to investors and say, look, we're not going to have the same growth, we're not going to have the same earnings growth as we had during the pandemic, and this is what our outlook is. It's a much more conservative outlook, and that's what's really hitting these stocks. It's that realization by investors that these pandemic growth stocks aren't going to benefit from that pandemic forever, and growth rates are going to come down. But if Zoom can strike a positive tone on that on that subscription revenue going forward, I think it can do well. I think it can actually rise on that earnings report. Salesforce, another one, down 33% from its November peak. Not necessarily a growth stock, but it is still growing very well. It's not a small company, $205 billion market cap. But it is expected to report earnings on Tuesday, report earnings of 75 cents a share on $7.25 billion. Now, I own the shares. I don't expect a big pop here on the earnings, though. Stock is still relatively expensive at 7.5 times on that price to sales ratio. Okay, the growth rate is fairly good here. We can actually go in here to the statistics and check out their revenue growth. Revenue growth is 26% annualized. So, even though I say it's not a growth stock just because it's so large and it doesn't typically do these, 25, 30, 40% growth rates, it is right now doing that 26%, year-over-year quarterly growth in revenue. But you can see here, it is still pricing for about almost 8 times on a price to sales basis. So that said, the downside is probably limited. It's a solid stock to own over the long term. What I do a lot of times in these cases, I'll invest part of my money ahead of earnings, and then wait till if the picture is more negative than expected and the stock comes down, then I've got some more money set aside to invest after the earnings as well. So you get that position ahead of earnings, just in case the stock does pop, but you don't go all in on that. Last one here is Snowflake. Snowflake is also reporting earnings on Wednesday. Shares of Snowflake have fallen 33% from November's peak. So another one of those growth stocks that that has fallen quite a bit. They do seem relatively protected from some of those other growth stocks that we've seen, just on strength in cloud services, right? Versus some of those other businesses in the pandemic era growth stocks, like Zoom, like Teladoc, things like that. Cloud services have been very strong for a lot of companies. Amazon, Microsoft. Cloud services have been one of the bright spots in their earnings reports. And so that's why I think we've only seen Snowflake fall 33% from its November peak. Company is expected to report $591 million in quarterly revenue on Wednesday, and about 4 cents a share. but it is still ridiculously expensive and in a very competitive industry. So I wouldn't be surprised to see a sell-off on this stock, especially if it does give a weak outlook like we've seen with a lot of these other growth stocks. Again, for Snowflake, I think they're doing some innovative things, but the shares are so expensive still, and it is in such a competitive market. Okay, price to sales, this stock is still trading for 77 times its annual revenue, right? So extremely expensive. We just saw some of those other growth stocks trading now at under 10 times price to sales. Snowflake's still at 77 times on a price to sales ratio, and in that very competitive market. Okay, cloud services, it is not something that's going to be able to dominate. It's going to find it very hard to take share away from Amazon, take share away from Microsoft. So I think I think that's one that I would still shy away from for quite a while. Next, I want to talk about some things that I've seen develop in the cryptocurrency space. Why cryptocurrency really isn't falling much more than it has been. In the past, if the market was down 1%, 2%, 3%, then cryptocurrency would be down 10% or 15%, right? And we're actually seeing cryptocurrency, the Bitcoin prices anyway, follow the Nasdaq, follow those tech stocks, right? So I think Nasdaq is down something like 14% so far this year. Cryptocurrency, Bitcoin anyway, is down about 16 to 18%. So very much less volatile than it used to be in the past. And what I think this points to is just that increase in institutional ownership and interest in Bitcoin. If we look at one thing, interesting news article I saw last week was SEC or filing mentions for the SEC 13F reports. Okay, so all your big, large money managers, hedge funds, things like that have to file a 13F disclosure every 3 months with the Securities and Exchange Commission, showing their investments, showing what companies they have dominant positions in, where their investments are, things like that. And the number of filings mentioning Bitcoin and cryptocurrencies, you can see here in this chart, have risen for quite a while, all the way since 2017. Really, have been rising. The number of institutional investors, large money managers, and whatnot mentioning Bitcoin and cryptocurrencies, saying that they're getting into these. But it just exploded higher in the fourth quarter. You can see this in the fourth quarter. Mentions in 13F disclosures rose to 155, rose 158%. During that quarter. So we're now seeing. I saw another survey over the weekend that said 80% of the institutional investors, those hedge funds, private equity firms, things like that, 80% said they're now able to start investing in cryptocurrency. They were prohibited before by their mandate. They're now able to start investing in that. So what I think you're seeing, and why cryptocurrency, why Bitcoin and those other tokens are not falling quite as much as maybe you would have expected in the past, it's because even as retail investors, even as a lot of investors get scared about a crypto winter or something and leave the space, you've got so much money coming in from institutional investors. We're also seeing Bitcoin, especially, and other cryptocurrencies. We're seeing them take a real apolitical stance, a real purpose during this conflict. We're seeing something like $10 million has been donated through Bitcoin to Ukraine, the military and the different organizations in Ukraine. So we're seeing it being used as a kind of an apolitical donation tool, which is very important and a very good use for it. We're also seeing it grow in its importance as protection from a destruction of your own currency, right? Again, as we said, the ruble in Russia has plunged 35%. Okay, so far since this conflict started to its lowest ever, right? The central bank had to double interest rates to 20%. And this is kind of a trend that we've seen in Bitcoin, in cryptocurrencies over the last several months in a lot of other countries, right? In countries like Turkey, where the inflation rate has jumped to, I think Turkey, it's something like 60% or something, right? And Venezuela, it's triple-digit inflation. A lot of these countries with sky-high runaway inflation, with currencies that are just being destroyed, the people, the citizens are looking to cryptocurrency, looking to Bitcoin to protect their money, right? They put their money in Bitcoin, and so that devaluation in their own currencies doesn't affect their wealth. Okay, and this is why you see a lot of countries trying to prohibit, trying to regulate, trying to ban cryptocurrencies, because it gives their citizens a way to get that money out of out of that currency, out of their domestic currency, and into a safer asset. You've seen different countries react to it differently. China has completely banned it. Saying their citizens can't use Bitcoin or other cryptocurrencies. Russia is trying to regulate it. The Russian central bank came out in favor of a ban, saying that they thought the Russia should ban all cryptocurrencies. The ministry of finance in Russia and the government came out in favor of just regulating it, so being able to watch it, right, instead of turning it into a black market thing. If you ban it, then they want to regulate it, they want to tax it, and they want to control it, right? Which obviously, when you talk about Bitcoin and cryptocurrency, trying to control it is something that's probably not going to be able to be feasible or plausible. But they're trying to control it rather than just ban it completely. But anyway, it is Bitcoin cryptocurrency. It is offering a way, a route or a use for people to be able to protect their wealth and their money away from devaluations in their own currency. So I think that's why you don't see Bitcoin fall more than it has. I think it's down to we can check today. Looks like cryptocurrency or Bitcoin is now down just slightly, still about 38,850 a token. So that's very close to that $40,000 handle. So I think you've got real support here for Bitcoin. If it falls down to 35,000, which I doubt it will, but very strong support at that level, and I think that really helps support it and drive it higher during this next leg. One last news item that I wanted to point out, and then we'll get to question and answer. One thing you gotta understand here: the Securities and Exchange Commission, the SEC, is now continuing to push more restrictive investor options. Restricting investor options, push investors away from a lot of these higher risk, higher return investments that are available, and really a lot of it's been under the guise of investor protections, right? Is that we've seen it in cryptocurrency. We're now seeing it with other investments, other alternative investments. What I'm talking about here is the SEC expected in April to start reevaluating a change to the accredited investor rule. Now, if you don't know what that is, the accredited investor rule came about after the crash of the 1930s, and just says that to be able to invest in a lot of these alternative investments, hedge funds, private equity, startup funding. You see these billionaires like Peter Thiel, how they got rich, how they made their billions. They invested in startup companies before they were stocks. Before they issued shares. Peter Thiel made over 1,000% return on shares of Facebook because he was one of the first outside investors in that. You get Mark Andreessen investing in Google, investing in Twitter. All these billionaires, they really got rich by investing in these startup companies. And the SEC says if you're not an accredited investor, you can't invest in these, right? And what is that? Accredited investor is anyone that makes over $200,000 a year or $300,000 as a household, or has more than $1 million net worth, not including their home, right? So you have to be rich. You have to be rich to be an accredited investor. And this thing is actually also called the sophisticated investor rule, because the SEC says that if you're not rich, if you're not this accredited investor, you're not sophisticated. You're not a sophisticated investor, and probably don't know what you're doing with investments, right? And it's really, it's bullshit that the SEC and the regulator wants to keep people out of these investments just because they are a little bit higher risk, right? They're a little bit higher risk, but obviously higher return, right? So evidently, the SEC wants to make your decisions for you, wants to keep you out of these investments. Again, the SEC is expected to start talking in April about raising that limit up to $10 million, right? So it used to be $1 million. If you had $1 million net worth, you could start investing in these alternative investments like private equity, like hedge funds, like startup funding. and you could take advantage of those higher returns. Now it's looking like it's going to be $10 million. So most of the population, 99% of the population, is going to be locked out of these things forever. And it's really exacerbating, it's really worsening that wealth gap between rich and poor, right? It's giving the rich, the already rich, the opportunity to take advantage of these high return investments, while it's keeping the poor out and keeping them in other things. So again, they're opening up public comments in April. So if you do hear that they open up public comments, we'll keep track of it and follow it here on the channel. When you do hear about that, you go to the SEC website, you go to their public comments page, and you say, bullshit. No, you don't tell me that just because I don't have $10 million, I'm not a sophisticated investor and can't make my own decisions with these. So just something to watch for. I'll keep you informed on that. Again, it's kind of a soapbox for me, kind of a rant, because I hate that they tell you what you should invest in and what you're sophisticated enough to invest in. We're going to open this up to comments here, or to question and answer. One of my favorite parts of the live stream, just being able to talk back and forth with you out there in the community. I'm going to go through this and look for those. Look for the questions here. If I don't see your question, please ask it again in the comments or in the chat window. Make sure you use the question mark so I can see what you've got there. What else do we have? Ivan, 200 ruble super chat. I appreciate that. Thanks, Ivan, long time member of the Bowtie Nation. Appreciate you seeing here. Missed you last week, but. I see I have to say it's not about strategic position. It's about Putin being Tsar. Just listen to what he said about Ukraine. He also said USSR breaking was greatest catastrophe ever. Yeah, I mean, you'd know better than I would probably, being there. I gotta say, I mean, I'm always been a big fan of that geopolitical history and how Russia, flexes its power or uses its power on the global stage. And yeah, I mean, it needs those warm water trade routes. It needs to access to the Black Sea. So, I think maybe I think obviously Putin, he's a demagogue. He's a megalomaniac. I think he's got a lot of problems. But I do think the greater issue with Russia is it wants to be able to bully. And I say Russia, I don't mean Russia. I don't mean Russia and its citizens. I mean, obviously, Russian citizens, Russians aren't any more Putin or the government any more than I am the U.S. government or whoever's leading us at one point. But I think it's been very important for the Russian government and for the Russian military to have access to those and that. So I don't know. I mean, like I said, I think it's much more. As you saw last week with the threats to Finland, the threats to Sweden, that it cannot allow or it will not allow them to become closer to the West and into those NATO and EU organizations because it threatens the sovereignty or the protection of the Russian borders there. What else do we have as far as questions here? Saw another. Intermediate Handyman, thank you for that. $5 super chat, I appreciate it. 5 Ark Funds have dragged my ETF portfolio down a lot. Should I cut my losses? Not financial advice. That not financial advice is another rant I have. I think too many YouTubers hide behind that mask of, this is what you should do. Buy this stock, but it's not financial advice. So, don't sue me, bro. It's bullshit. Okay. You know what? First of all, the financial advice, the advisory protection under the SEC. If you're a publisher, so if you're putting on a newsletter or a YouTube channel, things like that, you're generally not considered an advisor and with responsibility there. But the bigger picture is, I think, and I'm getting out of the question here, I realize I'll get back to that. But the bigger picture here is taking responsibility of what you're saying online, to your community, things like that. And I think it's just bullshit that so many YouTubers hide behind that. This is not financial advice, so do your own research, that kind of thing. No, I mean, I have experience as an advisor in venture capital with these investments. I stand behind my research. I have no crystal ball, so I can't guarantee anything. I will never guarantee returns or guarantee that a stock will go up or down. But I do my homework, and this is what I'm doing, and I'm just sharing that on here. But should you cut your losses in the Ark Funds? That's a very interesting question. Great question, though. We've been actually talking about Ark Funds lately. I think the Ark, Kathy Wood, her research and her analysts there at Ark is spot on with these innovative, disruptive companies. I think these are the companies that will change the future, will change the way we live. And I love some of these companies. The Teladoc, Zoom is also another one, although it's still a little bit expensive. Invitae, CRISPR Therapeutics, a lot of these companies that they invest in are great growth stocks. The problem is the valuations and how Ark is investing in them. Okay, first of all, the valuation. The valuations last year, up to February of last year, they were just ridiculously expensive. And that's in the past. You can't do anything about the losses. You gotta evaluate these. You got to analyze these stocks on the future. Okay, it sucks to be down 50, 60, 70%, on these, but what does the future look like for these? Are they now in good valuation territory? And a lot of them are. Okay, you've just got to learn the lesson that you always kind of set that line in the sand for 10 times price to sales, even for a company that's growing its revenue by 30 and 50% a year. Okay, don't get pulled into these growth stocks trading at valuations of 30 and 40 times on a price to sales basis, even if they're growing so fast that everybody says, hey, valuation doesn't matter. They're going to grow into that valuation. No, they're not. Very few companies ever do that. The only exceptions I'd say are maybe Tesla and Amazon. Okay, the only two stocks I can think of right off the top of my head that have always been expensive but have always always produced those returns. Everything else, you gotta draw that line in the sands with the price to sales. So that's really the problem that we got into with a lot of these stocks. But right now they're actually in good valuation territory. I've picked up shares of Sofi. I've picked up shares of PayPal and Teladoc, as well as some of these other growth stocks we're talking about, because they are changing the world in which we live. They're still growth stocks. They're still growing at 20 and 30% revenue growth per year, and they'll continue to do that. So at this point, they're still good growth stocks. Now, that's different from investing in the Ark Funds, though. If you've been watching, the community tab that we've got there on the channel, if you've been following some of the other things, Ark they've got some great research, but they are shitty at timing. Okay, they're talking about all these stocks as 10-year, 20-year stocks, growth stocks that they're in it for the long term. They've got huge long-term price targets on these stocks. And yet they've been selling them. They've been selling them like crazy. If you look at the Ark Funds, and this is something I've been wanting to cover, so I'm gonna look into this here and show you. If you go to the Ark Funds, okay, go to the Ark Funds here, and you can see how many stocks are in these. So we'll go to the good example here, the Ark Innovation Fund. You go here, and this used to be a fund of 55 companies, right? They've changed this. They've changed this to typical number of holdings, 35 to 55, right? And what we've seen, this used to be a year ago. This was 55 companies in this index or in this fund. It held a lot of really great growth companies. What has happened over the past few months is they have been selling a lot of these really good growth stocks, these long-term stocks. They've been selling them to raise cash to buy into just a few. This fund is now down to about 35 stocks. Okay, it's down from 55 into 35 stocks. So what you're going to see here is, whereas investing in individual companies, if you invested in Teladoc, right, or Palantir, a lot of these growth stocks that this fund used to have, then yeah, you'd be down, but you would still own that stock, and you would still be able to participate in that long-term growth story, right? You would still own the stock, and eventually that stock would take off and would prove that growth theme, and you'd make money. The problem with Ark, though, is it is sold out of these stocks. It is sold completely out of Palantir. Okay, this is something we talked about last week. It sold out of Palantir. I did the video on Palantir, how I thought it was at an attractive valuation now. It was up 10% the next day. The day after Ark Invest sold most of its exposure to Palantir. So what you saw is with the Ark funds, the Ark Invest funds, they dropped so much because Palantir was dropping, because Teladoc was dropping, because a lot of these stocks were dropping, but then they sold them at the lows. They sold them at exactly the wrong time. And when those stocks rebounded, Snap is also a great example. Ark Invest sold out of most of its Snap investment over the series of weeks, sold out of a huge position just before the earnings hit. Those earnings hit and the stock went up 50%. But you know what? Ark investors didn't benefit because the fund managers sold out of those stocks. So I mean, I do like the analysis you get from Ark Invest. I like the idea of those growth stocks, and I like a lot of the stocks they hold in it. I just don't like their investing strategy. I don't like the fact that they're getting scared out of a lot of these stocks. They're selling out of them and not giving their investors the opportunity to benefit when those stocks do rebound. Okay, so yeah, I think what you do is you sell those Ark funds that you're in, but before you do that, you go into the Ark funds, you go into the website there to see what stocks they have in those funds. You pick out, if there's 35, 50 funds in that fund, or 50 stocks in that fund, you pick out the 5 that you really like, the 5 stocks that you really think could do well and that are good valuations, and you invest in those instead. Okay, invest in the individual stocks instead of the funds. Because again, Ark has just proven it has no ability to time these things. It is not willing to give them the long term they need to rebound. And that's why you see these Ark funds crashing, even though a lot of the stocks that they've been in the past are rebounded, are benefiting. So great question there, excellent question. I want to take a few of these. What else? If you have high risk plays such as DraftKings and Palantir, what is your take on these types of stocks? Should we keep them or let them go? Both of them. I like both. Actually, kind of a hit and miss on those two. Right? DraftKings did a video. DraftKings a couple of weeks ago. How I thought it would do well into earnings because of the Super Bowl. Kind of disappointed management didn't point out the Super Bowl growth. I think they booked some excellent growth for the Super Bowl. Especially in New York, for those streaming stocks, gambling stocks, a lot of those right now it's all about subscribers. Okay, if they can put on as many subscribers as they can, then the stock price will do well because that's singularly focused what investors are focused on right now. DraftKings didn't do that, and DraftKings came down. Palantir, the other side, I did the video right before earnings for Palantir. It jumped 13% on the earnings. But I still like both of those. Okay, I like Palantir. It's still at a fairly good valuation, a little bit higher than where it was when we did the video. DraftKings, I made half of my investment. Like I said, with a lot of these earnings reports, you want to make maybe half of your investment at the most before the earnings, and then wait to see what happens in the earnings. Because a lot of these companies, they've been providing that lower outlook for 2022. That's sent the shares down, rocked 20%, on the day. That's going to give you a chance to pick up more shares at a discount because I still think DraftKings, some of these other stocks, Penn National Gaming is another stock in that space that I'm watching that I think I'll probably pick up. But I think they did better than expected on the Super Bowl weekend. I think in the first quarter earnings, when those come out, they're going to be able to show those results, and I think that's going to help support these stocks higher. So I still like both of those actually. Okay. What else? Political Economy 101. Can CFA take away your license for ethics reasons? Actually, this is something that kind of working behind the scenes here at the Bowtie Nation. I actually had a conference with the CFA, some of the CFA people. They didn't like me talking to you about Bitcoin, about penny stocks, about high risk investments, right? And so we're still seeing how that develops. I might just drop my CFA charter, let that expire, and leave that because if they want to tell me that I can't talk to you out there in the community about Bitcoin, about penny stocks, then it's no better than the SEC right now saying that you have to be a millionaire, a multi-millionaire to invest in any of these things, that you're not sophisticated enough. All right, I've actually got some recordings of that call with the CFA, with the members there, where they actually did say, do you think it's responsible to talk to people, to regular investors, retail investors about Bitcoin and about penny stocks, right? So, a lot of the older investors, a lot of the the bureaucrat investors don't want you to know about some of these stocks. They don't think you're sophisticated enough. They don't think you're intelligent enough just because you don't have millions of dollars in the bank, and and don't want you hearing about some of those things. So that's still developing, though. We'll have to see how that plays out. What else here? Looking for more questions here. Again, if you do ask a question, make sure you use a question mark so I can so I know that it is a question and I can respond to it here. Trasley asked, "What is the CFA?" The CFA is a Chartered Financial Analyst. It's a professional designation in the in the investment community. Used to have a lot more weight than it does anymore. Actually, it's 3 years, self-study program, 6-hour tests each year. Right, you go 3 levels, level 1, level 2, and level 3. They come with books that are about that thick. All the books. The curriculum is about 1,800 pages. And it covers, everything an equity analyst and a fund manager, a portfolio manager would need to know, right? All the way from, equity analysis, economics, macroeconomic stuff, analysis, everything like that, as well as ethics and, and trading, things like that. So it is, it used to be the go-to designation for equity analysts. Anybody that wanted to work on Wall Street or for hedge funds, private equity, things like that, you wanted to get the CFA charter and do that. So I did that in 2000 and started in 2009, got my charter in 2011, and have held it ever since. And again, all of the other stuff aside, it's a great curriculum. If you want to learn about investing, you want to learn what a portfolio manager does, how they pick stocks and things like that, check out a copy of the curriculum at your local library for free. You don't have to pay the couple, $100 for the curriculum online. Get the curriculum, study it. It's some great information, great material. But it's these bureaucratic, investing organizations that want to limit what you actually see and what you actually say as a charter holder. Okay, Paul wants to know, a longtime member of the Bowtie Nation. I appreciate that. Why is Teladoc going up today when everything else is falling? Hadn't looked at that. I would be pleasantly surprised if Teladoc was going up, because like I said, I've been picking up more shares over the past couple of months. So let's look at. We're just into the market and about 22 minutes into the market. Nasdaq is down 0.8%, S&P down 1%, Dow down 1%. Teladoc is up 5% though. So we'll just scroll through here. Jumps after teaming up with Amazon Alexa. Okay, so it looks like Teladoc must have signed some kind of an agreement with the Amazon Alexa voice, the voice thing there to. We'll go into the Newswire thing here. Okay, global leader in whole personal virtual care experience with Amazon Alexa, launch a voice-activated general medical virtual care supporting Echo devices. Okay, so basically, the Teladoc is signed with Amazon to be able to offer some kind of virtual care through the Amazon Alexa, which is a little odd. I guess Alexa is going to defer to Teladoc for some kind of virtual care and that kind of thing. It's a huge news for Teladoc. And again, even without this, I think the shares are undervalued. I like the shares. I've been picking up more shares over the last couple of months because again, this is one of those growth stocks that is still a growth stock. It's a quality growth stock. They do have positive earnings. If you look at expectations, management has expectations to grow sales by 20% at least over the next several years. Gets them to, I think through 2024, the expectation is for $4.4 billion in sales by 2024. And if you do the math here, just quick back of the envelope math, $12 billion company right now. If they hit $4.4 billion in sales by 2024, that is trading for just 2.7 times on a price to sales basis. That is extremely cheap for a company growing its sales at 20% plus every year, right? So even with this 6-7% pop today, I think these are still attractively valued. Teledoc, it is not going to. You're still going to go to the doctor for some things, but this is the future of healthcare. Okay, this virtual healthcare, not just during the pandemic. We are going to start using this more and more, for other healthcare things. And obviously, this Amazon Alexa tie-up is big news for that company. So great question though. Hadn't seen that yet, but thanks for pointing that out. Thoughts? Orc 145626 wants to know thoughts on Roku and Square. Actually covering Square in a video coming up, I believe on Friday, talking about Square and talking about some of the stocks that have been hit. We talk about Square a lot in the in that metaverse and Web 3.0, as well as the cryptocurrency and the digital wallet space. I think Square, Square is one of those that it's hard to ignore, right? Because not only do they have the digital wallet, which I am hugely positive on digital wallets. That's why I own shares of PayPal. PayPal is probably one of my largest holdings because it does have that Venmo app, that digital wallet that could make the shares 2-3 times what the current price is. Square has the Cash App, right, which is also in that digital wallet space. So I think it's got growth there. With Square, I think you're also getting that Web 3.0 kind of theme as well. And that's what we're going to cover, in that video on either Friday or next Tuesday. But I think with Square, you get both of those. It's very attractively valued right now at just, I think, 3.2 times on a price to sales basis for Square. So I think Square is another one you can pick up very cheaply, and it's a growth stock. It's innovating, it's changing the way we live in so many different themes. So I really do like Square. Roku is something else. Roku, I think, is. We'll have to check that out because I don't know where the price to earnings or price to sales is for that. Roku, it's I think it's still fairly expensive. It is one of those that have sold off. It was one of the pandemic darlings that everybody loved it. You can see here it is trading for about 7.1, 7.2 times on a price to sell. So it's under that 10 that I usually like seeing. But the problem with Roku is I just don't see any kind of competitive advantage. I just don't see how it does streaming better than a lot of these other services. Okay, I actually looked at Roku, compared it to the streaming service that we have on our TV here, and I didn't see any difference. We have the same apps, we have the same access to different streaming services through ours that we would through Roku. So it's really hard to see how Roku has any kind of a competitive advantage or anything other than maybe first movers advantage on these streaming service providers, that kind of thing. So Roku, I know it made a lot of people money while it did. It's come down. I'm avoiding the stock. I'm still not paying 7 times on a price to sales basis for something that I just don't see how it competes against some of the other alternatives. It seems like a very commoditized service, right? That it's selling, and it's just not competitive in that. Beef Bulferson, I appreciate that. Thank you for the $7 super chat. Let me know if you've got a question there, and I'll get on that. What else? Kathy sell. Okay, so Jeff wants to know, why did Kathy Wood sell these stocks? And a lot of it is, they're having fun. They're having redemptions. People are asking for their money back, selling the Ark Invest funds. So they have redemptions in these. They have to sell something, and they don't want to sell it against the stocks they want to keep. Don't want to sell it against Tesla. They don't want to sell their. I think they still own Teladoc. They still own Zoom. They still own 35 stocks in that Ark Invest, the Ark Innovation Fund. So they're kind of picking off the stuff that they don't quite believe in quite as much, right? And as we've seen, they're just making horrible timing decisions on them. They're selling off these stocks sometimes the day before those stocks pop, right? With Palantir 10% up the next day, with Snap up 50%, fall in the weeks following when they sold it. Virgin Galactic was another one. They sold out of their almost all of their Virgin Galactic stake last year, and the stock was up 20 or 30, 25%. Within the next week. So, it's not that they're wrong on these stocks. They are good long-term growth stories, but you got to give them that long-term. And, Ark just isn't giving them, they aren't able to give them that long-term story on it because they have these redemptions. People are selling out of the fund, and they need to cut exposure to something. What else? Could you explain some more? Dividends would be taxed twice. Do I manually add dividends to cost basis? Okay, so Durante, I guess, wants to know, Can you please explain why dividends could be taxed twice at the end of the year and then sale? Do I manually add dividends to my cost basis? Thank you. No, dividends are taxed differently from the rest of your stocks. They are taxed twice, though, in a way. First of all, you pay your taxes on your income, right? You pay taxes on your income. Whatever's left over after that, you can invest, right? You can invest in dividend stocks that are going to pay those dividends. Okay, then when those dividends hit your account, when you collect those dividends, you're going to pay taxes at the end of the year for those. Whenever you pay taxes in your country, right? So you pay taxes on dividends but not as like capital gains. These are different. These are going to come to you in a different part of your form, your 1099 DIV, right? From your investing app, right? Your E-Trade or TD Ameritrade, whoever you use. They're going to send you a form before tax time that says all the dividends you collected and whether those are qualified or non-qualified dividends, right? Qualified dividends, if you hold a stock for 60 days around that dividend date, right, around when you've got that dividend, 60 days around that, whether it's 60 days before, 60 days after, doesn't matter, 60 days, then you pay a lower capital gains tax on those dividends, right? This is still apart from all your other stocks, your capital gains stocks, all those, the stocks you sold, that kind of thing. This is just dividend taxes, right? If you don't hold your dividend stocks for that 60 days, around the ex-dividend date, then you're going to pay your regular income tax rate on those. Okay, so it's very important. Hold your dividend stocks forever, but at least hold them for 60 days around that ex-dividend date. You'll pay the lower capital gains tax, and you will pay those capital gains taxes on those. This is why I say that very important for all dividend stocks, for all income investments. If you can, you need to have those in a retirement account so you don't pay those taxes every year. Okay, if you have your highest dividend, and you can't do it with all your dividend stocks probably because you're only limited to like $6,000 in an IRA each year, or whatever other accounts you have. But your highest income investments, your highest yielding dividend stocks, you put those in a retirement account. That way, when those dividends hit those accounts, you don't have to pay those taxes every year. Okay, you pay those taxes when you take the money out in retirement, but you don't pay them every year. Otherwise, if they're in regular accounts, you pay those taxes on those dividends every single year. Okay, so that's how those are done. You don't manually add your dividends to a cost basis, anything like that. You just pay that tax rate on the dividends you collected. And again, the form from your investing manager or statement is going to show you what that is. Okay. What's the difference between stocks? Excellent question. Dog Fact 3 wants to know what's the difference between stocks and securities. Nothing. That's the same thing. It's stocks. You've got three words that people use to describe stocks sometimes. You've got equities, equity investment, equity, it's equity in the company. That's equity. Stocks, stocks, shares, or securities. Same thing, exactly the same thing. Three words describe the exact same thing. Stocks, securities, shares, equity, all that, same thing. Because maybe what averaging down in the kind of the market. Okay, Discover Math wants to know about explaining an example of averaging down in this kind of market. Okay, great question. You could talk about dollar cost averaging, DCA, averaging down. What I like to do, dollar cost averaging or averaging, now I don't want to say averaging down because it can work up too. Dollar cost averaging is basically just when you buy a stock, the same stock or the same fund at different times at different prices, right? So, a lot of people talk about this in averaging down kind of terms, whereas, if you bought a stock at $100 and then it fell to $50, that stock now at $50, it has to double to get back to where you're profitable. Okay, it has to double from 50 to 100 to where you paid for it, right? But if you still like the stock, if you still like the company, the fund, whatever, and you buy more at 50, now your average is 75, right? You bought at 100, you bought at 50. The average of that is $75. Okay, and what you can do is you just put in, do your little calculator, and here, let's see if we can. I'll show you how this works. Something just fell behind me. Okay, if you do a calculator on averaging down, you just take the total amount you invested. So let's say you invested $100 at 100, you invested another $100 at 50, and you got 2 shares, right? Just a real easy math here. You can do $200 invested total divided by 2 shares. Nope, you invested 150. Excuse me. If you invested you would have gotten 3 shares at 50 for $100, right? So 200 divided by 3 is going to be $67 average, right? Probably a bad example of that. But basically, yeah, if you buy more shares at a lower price, then your average comes back into that middle, and the shares don't have to rise by quite as much, right? In this example, if you bought 1 share at 100, 2 shares at 50, so $200 divided by 3, that's $67 average, and now it only has to come up from $50 to $67 to that average for you to start making money. Okay, so it's something a lot of people like to do with stocks that are falling. I do it, with stocks that are rising too. Okay, this does not mean you only wait till a stock falls to be able to dollar cost average or average your stock prices, right? If you really like a company, think it's a great long-term investment, buy more of that sucker every month, buy more of it every 3 months, whenever. You put a little bit more in, and that keeps you from having to time the market, right? You just building your portfolio, building your position in that stock over time. Over a series of 5 or 10 years, you're going to have lots of money in that stock, and it's going to do well. The problem with dollar cost averaging on the way down, now this is the problem here that you got to watch out for, okay, is you love a company, if you were in Teladoc or Zoom or, a lot of these growth stocks at the very peak and they started coming down, you're like, well, you know what, I just want to get back to even, so I got to buy more now so my average is lower. So when it does come back, I can be even faster, right? And you just keep plowing more and more money into these stocks. And at some point, all you're doing is pushing money into this one stock, and that stock becomes 20 or 30% of your portfolio. Okay, and the problem is that some of these stocks may never recover. Some of them might bankrupt. Some of them might be long-term companies, but never reach that same price. Never even get close. Okay, and now it's 30 or 40 or 50% of your portfolio, and you've got dead money there for years. Or worst case scenario, the company bankrupts and you've lost all that money. Okay, that's something that's very hard to come back from. And most investors, they just give up investing at that point. So feel free to dollar cost average if you really like a company, you really like that long-term growth story in it, then put more money in the company. But I'd say never have more than. I'd say more than 5%, but you can go as high as maybe 7%. Never have more than 5 or 7% of all your money in one stock or one fund, okay? Because even the best companies, good things happen to, or bad things happen to good companies, and even the best companies, sometimes they just crash. Sometimes they just go nowhere. Who remembers BlackBerry, right? The old Research in Motion from years and years ago. They used to dominate. They used to dominate the texting messages, the text message service. I had a BlackBerry. Everybody had a BlackBerry. You had to have a BlackBerry if you worked on Wall Street, right? Or in a lot of industries. And look at where that stock has gone over the last several years. They changed their name. They've never been able to really get into the phone market, right? And do well. And that money, if you started at the peak, or if you were investing at the peak and dollar cost averaging all the way down, had 20 or 30% of your money in there, that money would have gone nowhere and would be basically dead money for about a decade now. So again, feel free to dollar cost average, buy in more of a stock as it comes down. If you really like that company, but use those limits. No more than 5 or 7% of your money in any one stock at any one time. Okay. So I hope that explains kind of averaging down, dollar cost averaging, that kind of thing. What else? Do you think Expedia is still a good investment, or is it overvalued? Expedia, we've seen a lot of the booking sites, travel sites come down, especially over the last week. They've gotten hit very, very hard. So you have to look at these. Let's look at Expedia real quick. I know Booking.com, Booking Holdings was like the worst stock in the consumer discretionary market. Or the consumer discretionary sector last week. I imagine Expedia probably got hit pretty hard as well. So we do see Expedia is down, down from 217 52-week range. It's at 5 years. It's very close. It hit that 5-year high in this month. So Expedia has not been doing bad. We do want to look at the statistics here. I want to check the price to sales ratio real quick Price to sales 3.5 times on a price to sales basis. That's not bad. If it's a growth, I don't think it's necessarily a growth stock at this point though. Yeah, quarterly revenue growth of 150% year over year. I'd have to look into this more because it is not expensive, especially for a growth stock. If you look at, let's see what the analysts expect as far as sales growth over the next year. So sales growth expected for current year 2022 is expected 37% higher to 11.8 billion. Expected up 16% to 13.7 billion next year. 16% obviously quite a bit lower than than this year's growth expected, but it's still a very strong, very respectable growth rate for a stock only trading for about 3.5 times price to sales. So this isn't bad. It's come up quite a bit here since over the last couple of years. Really hasn't sold off with a lot of those other growth stocks and things like that. So I'd take another look at it, compare it against Booking Holdings, against some of these other travel and leisure websites. But just on an initial look right there, it does not look too bad. What else? What else do we have? I saw one on Sofi. Where do you see Sofi Technologies in the coming years? Sofi is awesome. So I bought more shares of Sofi over the last month. It's another one of those growth stocks that I really believe in, that I'm picking up shares on this, on this crash that they've had over the last year. Sofi is locking up digital finance. Okay, I think I see Sofi really in competition with PayPal and some of these other digital finance companies. Sofi, compared to a lot of the other financial websites like LendingTree or like some of these other financial online financial tools, Sofi has a banking license. Sofi owns a bank. So Sofi can offer a lot of those traditional banking services, that a lot of these other companies, these new fintech, these financial technology companies can't offer because they don't have a banking license. Sofi has that. Sofi has, a strong lead in, student debt and a lot of these online lending services, things like that. It is not expensive. At this point, sales growth is still very strong. We can go back into Yahoo Finance and look this up. But yeah, Sofi is one I've been picking up over the past month. Soji, it's not Soji, it's Sofi. Sofi Technologies. If you look here, it's up 3.8% today. Against a market that is down almost 1%. So always a good sign of support. You do see. Okay, so you see it. It did. I think it was one of those SPAC stocks, which I hated last year. I came out quite a few times on the SPAC stocks. How you really have to watch the valuation on these. They were ridiculously expensive. And Sofi, so Sofi is down from about $25 at its peak. It's down about half of that now. But if you look at year to date. It's been rebounding a little bit over this past. Looks like over this past week, it looked like it hit a bottom right around $9.82 a share. But again, this is one that I would keep on picking up. If it falls any lower or stays right at this level, I would pick up more shares. It is at 9.9 times, 9.87 times on a price to sales, so just under that point where I actually start looking at these growth stocks on valuation. So it is still fairly expensive, I guess I would say. But if you look at the sales growth on this thing and the potential, analysts are expecting next year's sales growth up to $1.5 billion, 45% sales growth on this stock. So that price to sales, if you adjust it for growth, it is not expensive. And again, I just think finance is transitioning into that digital world. Okay, 10 years from now, you aren't going to go to the bank. You aren't going to have traditional bank branches. You're going to do everything digitally, financial technology space, things like that. And Sofi is the leader in that. Okay, it's got its banking license already. It's able to offer those banking services, really move customers into that into that digital finance space. So I think it's one it's one that's going to benefit from that. Good question though. What else here? What do you think about? Very good. Your opinion, cannabis. Okay, what's your opinion on the cannabis industry right now? Seems like large growth and low valuation on some of the smaller companies. Can't remember. No, maybe I guess I didn't do a video. I highlighted it in one of these live streams, a video or cannabis a few weeks ago. Very similar to what we were looking at in September of, I believe, 2020. September 2020 did a video on cannabis, extremely low valuations, very good opportunities in those stocks, and the stocks just took off. It was something like doubled in some of these funds, over the next 6 to 9 months in those. It has since come down. The cannabis industry has sold off. The stocks have sold off like a lot of these other growth stocks. And I think this is another opportunity to get into these. Now, this is a midterm year, so I don't think you see any kind of regulatory movement or progress, as far as laws or regulations or anything that help the sector. But it is coming, right? Cannabis will be decriminalized, will be legalized in every state and federally eventually. And what we're seeing right now is different than in the past. Is these companies have plenty of cash to survive, right? In the past, the stock prices come down, and since they can't get loans from most banks, since federal legislation is still criminalizing cannabis, then a lot of banks won't loan to these cannabis companies, right? So whenever the stocks came down, they had real trouble funding their companies, funding their operations. Well, what we're seeing now is that they have plenty of cash flow from private equity, hedge funds. A lot of these other investment managers, they have so much fun. They have more funding than they need, right? So they are going to be able to still grow, still fund their operations throughout this throughout this market until investors come back into the stocks. So very, very safe and stable operations. And the stocks are at very low valuation. So I'd look again at those cannabis stocks. Some of the larger ones, I tend to like the larger ones a little bit more, like Kronos. I know some of these got bought out, but if you go here for an idea on some of these cannabis stocks, you can go here and look at the MJ, right? The ETF MG Alternative Harvest ETF. That's the main cannabis the main cannabis fund here. And you can see, over the past, so we did that video in September of 2020. It was at about $10 a share. It jumped up to more than doubled to $22, $23 a share. It's since come back down to about $9.50 a share. And again, an excellent valuation on these companies. What you can do if you go to, now I don't know if it says it in holdings. Yep, it does. So if you go to most funds, if you go to Yahoo Finance and you go to this holdings tab, then you can see what they're holding, right? So you can see, Grow Generation, Tilray, Canopy, Aurora, Kronos. You see what the biggest stocks they hold in that fund, and really the biggest support or the biggest expectations for these stocks, right? If this main cannabis ETF owns almost 10% of its assets in this one company, in Grow Generation Corporation, that's ticker GRWG, they must be pretty confident in that company, right? And you can see just the top five companies here, probably about almost half of the fund, we'll call it 9.18, 7.4 plus 6.28 plus 6.1. That's 38% of this fund. So more than a third of this fund in just those 5 companies. I think that's where you go. I think if you want to own these stocks, own these cannabis stocks without paying the higher expense ratio on this fund, which is fairly high. I think it's about 0.6%. 0.75% expense ratio you have to pay to hold this fund. I think instead of doing that, you go in here, you go to holdings, and you pick off these top 5 stocks. You pick off these top 5 stocks, invest in those, and I think that gives you the majority of the exposure to that industry and to those upsides. What else? Rumster Fire is a dumpster fire of an app. I don't know. I haven't used Robinhood in quite a while. What else? E-Trade is killing me with the fees. Robinhood and Public don't fee me, but Robinhood and Public don't offer some of the hard-to-find assets. What are your favorite brokerages? Okay, great question there. I actually use a couple of those. I've had E-Trade since E-Trade was my first investing account, right? When it was Brown and Company in 1999. Lowly corporal in the Marine Corps, opened my first investing account when it was Brown and Company, and it was because Brown and Company was the leader in that low-cost investing, right? Most of the other apps, Schwab, I think TD Ameritrade was around then. They were charging like $15, $20 per trade, right? Brown and Company came out. They were the first ones to come out. $5 flat fee per trade, per stock purchase. So I got an account there. They were acquired by E-Trade, and so I've had an E-Trade account ever since. it's fairly, it's fairly good. Lots of research on E-Trade available. Fees aren't too bad. I don't know what you're doing on them. Maybe maybe the options fees are a little bit higher. Stock trade fees, most of them are zero commission on those. I know the margin cost on E-Trade is very high, so I don't trade on margin on there. But I generally like E-Trade for for research and for my retirement accounts. Public, I've used Public in the past and still have some money on there. I don't use it a whole lot. I like it for the social aspect where you can kind of see and talk to people about different stocks and see what other people are trading. So I do use that. Robinhood, I've never really liked Robinhood that much. It's okay. The free stock was always great. So I think they, and you got to give them credit for really lowering the bar on that commission-free kind of thing. Without Robinhood, we'd probably still be paying commissions on a lot of these other investing apps, but really Robinhood set that off. I use Webull quite a bit because for a lot of the trading and research on there. I love Webull for their stock, their simulator, right? You can get $1 million paper money, follow your stocks, follow your strategies before you invest your own money. So I do use Webull. I also use a couple of these. I've just started using Interactive Brokers, another very low cost one, but it's a little bit more for traders and technical analysis. So some of the ones I like. The important part is, you can have as many investing accounts as you want. And a lot of these apps, they're better for one thing than another. Like I said, Webull is very good for testing out your ideas, for maybe some trading. It's got some good research, but it's not quite as good for that long-term hold or the long-term research, right? For that, I use E-Trade. For some of these other things, if you just want a set it and forget it type of portfolio, M1 Finance is great for that. No fee investing. You create your portfolio with how much you want in each stock, and you put your money in, and that's it. You don't even have to look at it. It's going to automatically put that cash to work in each of those stocks in your portfolio, and you don't even have to worry about it. So different apps for different things. Find which one you like. Even if you have one you just like for research, like I do for E-Trade, doesn't mean you have to have any money on it. Have $100, have the limit, have the minimum on there, and just use that site for research or something. Stuff like that. What else? What's on Clover Health? I see some questions here. Clover Health, really haven't looked at Clover Health. I know it was a big SPAC stock, in the day, and I really had a hard time believing in those SPAC stocks and the stocks that came to market through the SPACs. They were terrifically expensive. Clover Health, I don't know. I'd have to look at it. Basically for these, it's got to be a decent valuation now. It's got to be a valuation under 10 times price to sales, right? And preferably lower. It's got to have a competitive advantage. What is it doing that these other companies aren't doing? I really haven't seen much of a competitive advantage in Clover Health when I have looked at it. So, I'd have to look at that one again for you. USW reverse split. P green stocks have a comeback. Other position. Considering closing. Are there any positions you're watching and considering closing? Not off the top of my head. I can't. I rarely close out stocks. If I buy a stock, then it's in it for the long term, right? So I'm going to give it at least 3 to 5 years. Especially a lot of the penny stocks, you got to give them a chance to grow into that thesis, grow into that theme, right? If you're getting scared out of the market, like Ark Invest is, or if you're getting limit ordered out of the market and having to sell a lot of these stocks, you're just going to be disappointed, because I guarantee you, as soon as you sell some of these growth stocks, then that's going to be the time that they pop higher, right? And over the long term, you're going to look back at them and say, holy shit, I could have been rich with these stocks. Look at Amazon. Perfect example right now of what's happening with these growth stocks. Amazon, I think it was up to the peak in 2000, 1999, 2000. Amazon was up to $120 a share. It had just went IPO, like a year before that in 1998. Of course, .com crash, everything sold off. Amazon was down to $5.60 a share by 2002, okay? It had fallen something like 85-90%, right? So investors obviously scared in the stock, worried about their investment in the stock. That stock is now worth over $3,000 a share, okay? Over 600 times your money if you had just held on to that $5.60, even if you had bought at the peak at 120. So great example for a lot of these growth stocks. A lot of investors bought at the peak last February and are down, that 80 or 90%. Even if you bought Amazon at its peak at like I think it was $120 a share. Right now it is. Well, let's check. Let's check exactly where it's at. It was right around 3,500, I think, at one point. Right at $33,000, $3,000.31, or $3,031. Even if you had bought at that peak, at the all-time high in 2000 for Amazon, you would still have 25 times your money over the past 20 years. That is an amazing return, right? So look at your growth stocks. Have faith if you still like the growth theme in that stock, in that company. If you still think it's going to change the world in which we live, and the growth is there, you got to give it time to prove that theme. You got to give it time to prove this 25 times, because if you've got 5 or 10 growth stocks, yeah, most of them not gonna return 25 times your money over the next 20 years. But just one stock that does 20 or 25 times your money, that becomes the next Amazon in its space, that's gonna make it all worth it. That's gonna boost your portfolio. So we're gonna close it up for this week. I appreciate it. Thank you all for being here. These Monday live streams, love doing these, connecting with you out there in the community. We got videos every day of the week here, Tuesday through Friday. So stay tuned for those. If I didn't get to your income, or if I didn't get to your question, please ask it in the comments below, and I'll try to get to it later today.